All right. Well, it is a little bit past the top of the hour, so we'll go ahead and get started. My name is Phil Daniels. I'm an advisor at Brand Asset Management Group. I'm joined today by Ryan Bouchard, our investment analyst. And we want to thank you for taking the time to spend part of your morning with us as we review 2021 and share our outlook for 2022. Probably going to run about an hour. We'll try to allow a little bit of time to answer questions towards the end. If you do have any questions, this Zoom format creates a really smooth mechanism for that. There is a tab at the bottom of your screen labeled Q&A. And if you click on that, that should pop up and you can enter any questions you have. Ryan and I may not get to the question immediately, but they will show up for us, and we'll be able to see those questions and respond to those either as it dovetails with the topic we're covering, or, like I say, potentially at the end of our prepared remarks. We're going to cover a lot of data today. Ryan and I both enjoy the analysis aspect of our jobs and sharing the data with you. But before we jump into some of the charts that Ryan has prepared for us today, just wanted to start with an introduction. 2021 was a good year. The S&P 500 was up 28.7% for the year, and that comes on the heels of 2020 when the S&P 500 was up 18.4%. So two really strong years, certainly above our long-term expectations for the S&P 500. And it's a little bit surprising. Any of you who would have met with me early in 2021, I probably would have said something as insightful as 2020 was a good year. We expect 2021 to be another good year, but not as good as 2020. I was wrong. And so I just wanted to start by admitting that it is exceedingly difficult to predict what markets will do over a very short period of time. But hey, that doesn't stop us from going out on the limb once in a while. So we're going to share some thoughts with you today. We'll get into the 2022 outlook. And as much as giving a prediction is what the market will do, the more important element of this conversation, we think, is sharing what we think some of the primary factors will be. What issues will the markets be focused on that will be either positive or negative elements affecting the performance of the stock market and bond market in the coming year? As we think back about 2021, oh my goodness, was there a lot going on? You know, obviously we were still dealing with the coronavirus. It started with the new Delta variant, which now that's old news. Now we're focused on Omicron, and that really, as new developments came into play, you saw positive developments give the market an opportunity to move up, and you saw negative developments, particularly new variants and new news that the market had to digest, would put a pause on any upward momentum or even cause a sell-off until we got enough clarity to realize, okay, there's this new Omicron variant, but maybe it's not quite as serious as the other versions of it. And even though it's spreading quickly, the hospitalizations and fatalities aren't as high, and the market would react positively because the market was focused on what are the economic implications. Is this going to cause government agencies to cause businesses to shut down again like they did back in 2019? Or I should say early 2020, forgive me. But that then leads into the supply chain disruptions, which were another significant part of 2021. And you know, it resulted in higher pricing. It resulted in an inability to get things that consumers wanted, at least in a timely fashion. And that was a major theme that then led into building inflationary pressures that as 2021 unfolded, you know, the original thought was, and the Fed articulated pretty consistently through the first half to 2/3 of the year, that those inflationary pressures were likely to be persistent because they were supply chain based. And, you know, eventually businesses that are producing these products are going to kind of get caught up with the demand, and then we'll get back to more normalized pricing. We'll talk about that in some more detail today, but what happened as the year progressed is the Fed and the markets began to acknowledge, no, you know what, these inflationary pressures may not be as transitory as we thought. They may be more persistent. We'll talk a little bit about why that is the case. As a byproduct of those inflationary pressures, you saw the Federal Reserve responding to that. The Federal Reserve is still incredibly accommodative in their positioning, but they have begun to slow the rate at which they stimulate the economy. They did that in 2021 primarily by beginning to reduce the rate at which they're buying bonds. They still haven't raised rates at all, but that's clearly an area of focus moving into 2022. And the market is acting in anticipation of what the Fed will ultimately do, which is why what the Fed signals is so critically important. And even today, as we're conducting this webinar, Federal Reserve Chairman Jerome Powell is currently testifying before Congress as part of his renomination confirmation hearing, and he will be asked questions about some of the things we discussed today. And so as quickly as we finish recording this webinar, parts of it may become a bit dated because we may get some new information from Chairman Powell. I don't expect a lot of surprises. The Fed has been doing a good job of communicating what their strategy and plans are and how those have evolved. But the key takeaway is throughout 2021, the Federal Reserve and monetary policy was still stimulative. Government response to COVID, the fiscal policy side of the equation, was also stimulative. The amount of government spending that took place in 2021, and specifically the passage of the infrastructure bill, really does provide additional spending that is a stimulative impact to the economy, and fiscal policy along with monetary policy both are helping to fuel economic growth, and that was the story of 2021. We had good economic growth. Quarter by quarter, you did see a little bit of a slowdown in the third quarter, but we'll talk about how we should view that and that might mean going forward. But the economy was growing above trend, and that then led to the final comment that I would share, just kind of macro, what was 2021 all about? And that was strong corporate earnings. You know, if you look at corporate earnings, particularly how they compared versus the prior year, which had more of a COVID impact, we saw a lot of significant earnings growth. And some of the charts that we share with you today will put that into a picture for you that'll help tell that story. So by way of introduction, that's kind of the review of 2021 very briefly. But what does that mean for 2022? And I don't mean to just repeat the same things, but a lot of those themes are still going to be issues that markets are going to be watching in 2022. I'll say the same thing at the beginning of 2022 that I was telling people at the beginning of last year, and maybe I'll be right this year. I still think 2022 is likely to be a good year for markets, but not as good as the last 2 years. I do think that we should be prepared for a higher level of volatility as markets react to some of these data points. And clearly, stock prices have moved up. We ended 2021 at very near highs. We've had a little bit of a pullback here to start the year as markets have digested some of the new news. I think that it would be reasonable for us to expect a correction, which would be a decline of 10 to 20% at some point during the year, only because it's been a while since we've had one. And it's not uncommon to have a correction about every 12 to 18 months. And so we're kind of a little bit overdue. But again, there are a lot of positive things going on that have probably contributed to the length of time that has passed since the last. There is, of course, always the possibility of an unexpected shock to the economy and market, something that is completely unexpected. And by definition, we don't know what that could be. But barring something unexpected kind of out of the blue, it looks like we're set for some pretty good growth in the economy and earnings profitability that could lead to some support for stock prices. In terms of the factors that we just walked through, there is some optimism around COVID, and that by the end of the year, it'll be much less a factor than it is right now. There are some theories circulating around Omicron. While it's more quickly transmitted and more transmissible, it's not quite as severe, and maybe that bodes well. I don't know. I'm not an immunologist, but there is some optimism around COVID being less of a factor as the year unfolds, and that supply chain issues that we've been dealing with will begin to ease. Now, as we talk about inflation, supply chain issues aren't the only thing driving inflation. And we would say as we move through 2022, it'll be interesting to watch labor costs and housing and how those two factors play into inflation. So we'll dive into that a little bit today as well. And that will likely cause some continued inflationary pressure, but maybe not quite as high of an inflation rate as what we saw in 2021 as some of those other pressures ease. The Fed has been slowing the rate of their bond purchases, and they will, in probably towards the end of the first quarter, will reach a point where they will stop their bond buying. And once they've done that, they will begin raising rates. The debate that the market is having right now is the Fed going to raise rates 3 times, or will they raise rates 4 times? And that's something that maybe we get a little color from Jerome Powell today as he testifies. But what has been communicated and what has rattled markets a little bit recently, just in last week, is an expectation that the Fed's first rate increase may come earlier in 2022 than was originally anticipated, as they try to catch up with inflation, and as they acknowledge that the labor market is pretty healthy now. We're below 4% unemployment, and the expectation is by the end of 2022 we might be as low as 3.5% on unemployment. So that's another element that the Fed is watching very closely, and I think is giving them the ability to begin raising rates a little bit sooner. The market has had to adjust to that change in expectations. Government spending is also likely to remain accommodated. So even though the Fed is taking these actions, and at some point they may even begin shrinking their balance sheet. They may be not just slowing the rate at which they buy bonds, they may become net sellers of bonds as they shrink their balance sheet. And even as they do that, throughout 2022, the Fed is likely to still remain in an accommodative stance. Government spending will also likely continue to be stimulative. It's very uncertain as to whether Build Back Better, the legislation that has been advanced that hasn't yet found enough support in the Senate to get passed, it's unclear whether that's going to come back and whether we'll have a revised version of Build Back Better. Clearly, the Democrat Party is looking at that and trying to figure out what could they do. Just my opinion on the issue is I think the later in the year we get, the closer to the midterm elections we get, as we look forward to 2022, we get an election thrown in. One more thing that we can focus on that will cause some volatility for markets. But I think it's less likely that Build Back Better in some modified version we get past the closer we get to the election. So if something's going to happen on that front, again, just my personal opinion, I think it's probably sooner rather than later. But the fact of the matter is, the analogy I like to use is that of a car accelerator, and I think I was taught this when I was in my very first economics course, a lifetime ago now. But the Fed and the government, both through monetary and fiscal stimulus, respectively, have basically had the accelerator of the car on the floor. They've had the pedal to the metal, if you will. And even if there are steps taken where the Fed begins to take action to reduce it, you hear people talk about taking the punch bowl away from the markets, and there's truth to that. But the accelerator may not be on the floor, but the foot's still on the pedal. And there's still a stimulative effect in place that's likely to contribute to faster growth of the U.S. economy until subsequent steps are taken that probably continue into 2023 or maybe even beyond. And so all of that continued economic growth yielding continued corporate profitability, maybe accelerating at a lower rate than what we have seen. But those are some of the core expectations that we have. And I'm going to take a breath and take a drink of water and let Ryan get a word in edgewise here as we begin to cycle through some of the slides that we put together to help maybe tell that story in a little more depth and connect the dots on why we think these are the factors markets are looking at. Ryan?
All right, great. Thank you. Great overview. Thanks everybody for joining us. And yeah, as Phil kind of alluded to there, it was a great year for 2021. Looking for, still strong trajectory in 2022, but with a little bit of indigestion maybe throughout the year. as we kind of transition from what was a pretty obvious trajectory of we're coming out of this pandemic slowly but surely, making better progress. And now as we kind of transition here, the accommodation given to us by the fiscal authorities and the monetary authorities are kind of being pulled back a little bit. So let's take a look at how the markets did in 2021. If I can get the slide to go forward. There we go. Here's what the different segments and asset classes looked like for calendar year 2021. All of the red bars here are U.S. stock market. You can see still kind of a bias towards large cap stocks here, smaller cap stocks, which started out the year. There was a pretty good rotation at the end of 2019. The end of 2020, going into small caps and into value stocks. And as we, as the year 2021 progressed, large caps again kind of outperformed. In the international side, that's the purple bars here in the center. Again, international kind of underperforming the U.S. markets. I attribute that a lot to the path of COVID. We have antivirals here. We've got vaccines here in the U.S. Widely distributed, and so we are making more progress than most of the rest of the world as far as exiting this situation. And so you see it in our economic numbers. You see it in our markets. Our stock markets are rallying more than they are in other countries. But that is a wave that it kind of goes through, and then as we outperform, and then as we're kind of on the back end of that, you should start to see international stocks kind of, as they emerge out of this, they will outperform U.S. stocks at some point. So just a theme for going forward. I'm not necessarily predicting it for 2022, but just, that's something that we keep in mind. We always want to stay diversified. These international stocks in particular are quite a bit cheaper than the U.S. stocks at this point. We'll get to that a little bit later in the presentation. Real estate really was the big winner for the year. Maybe counterintuitive, maybe intuitive. Exiting 2020, everybody thought, well, nobody's going to need office space anymore, right? Everybody's going to work from home. Nobody needs to go to a shopping mall anymore. Nobody needs to even go to Target or Walmart anymore. Because Amazon can bring everything to your doorstep. And so if we're going to be stuck at home and we're in a pandemic, what do you need real estate for? So real estate sold off really hard in 2020, and it had a huge resurgence in 2021. This I would show you is just global real estate. So that's, including international real estate. I would say if you look at just U.S. real estate, you're up, that segment is up 40+% for the calendar year. Alternatives I'll talk about here in just a second, but it's important to note that all of these blue bars here are the bond market, different types of bonds. Because interest rates rose during the course of 2021, for a large part of the bond market was down. We'll talk about that a little bit later, but the orange bar here, alternatives, are what we use to also kind of moderate the volatility in a portfolio for investors. And so it's important to note that while the bond market was down for the year of 2021, alternatives did what they were supposed to do, and that was provide some ballast to the portfolio that's a little less correlated to equities, not correlated to bonds, has less interest rate sensitivity. And so they did hold up well. They did what they were supposed to do. And so that's something that we look forward to, because interest rates, we feel like they're pretty low, and they've got to go higher at some point, whether inflation pushes them higher or not. That is a challenge for the bond market as a whole. We'll get into a little more detail a little bit later. The path of COVID here, as Phil kind of alluded to, this is since the beginning of COVID showing up. I found this chart interesting because they mark every every get together, every holiday. And so you can kind of see after, July 4th holiday, a lot of people getting together, and all of a sudden you got a big wave in infections. The good news here, and I would say, okay, so, well, the bad news is that we ended the fourth quarter with a record surge in infections as we got through Thanksgiving and Christmas holidays. The good news, though, is that the hospitalizations, the blue line here, these peaks are getting smaller and smaller. And so I've seen this presented several different ways. In one way, it was presented as, we've got a new record peak in infections, but the hospitalizations are only about 40% of the prior high. And so this thing either is kind of, it's waning, it's losing some steam, or, at least the Omicron variant is less severe, which is a positive that I think, looking forward, I'm hoping that, and everybody's hoping that, we don't get a new variant that's like the Delta variant, a little more severe, but hopefully the Omicron variant and any descendants thereof are kind of what we're dealing with going forward.
Yeah, the one thing that I'd add on this chart is a lot of the research that we've seen about Omicron, and I didn't go to school to be a doctor or to be an immunologist or whatever. But as we follow the markets and the economy, this has been a major part of the story as we've shared. A lot of the articles that we've read suggest that there's probably about a 3-week lag between new positive test results and hospitalizations and mortality when you look at that data. And so even if you account for a 3-week lag, to Ryan's point, the hospitalizations are running much, much lower with this current breakout, which is one reason for the optimism that we're seeing as it relates to Omicron.
Yeah, and the question was then, well, it showed up in South Africa first. What does what do their waves look like? And I would say it looks positive because they've already crested, they've already peaked out in their infection wave and in their hospitalization wave, and so it sounds like what we're dealing with here is definitely a weaker variant, and we should see a peak here. I think I saw January 27th is when they expect our peak here in the U.S. for infections. So hang tight, hold on. Next slide here. I would just note, we are making progress toward immunity. This slide is from J.P. Morgan. They take the number of estimated infected in the blue here, the number of vaccinated in the green, and then the gray bars here are the kind of breakthrough cases, those who have been vaccinated, but then also infected later. They estimate that we are kind of, above the 90% of the population having had this in one form or another, whether through vaccination or whether through infection. So, making good progress, sometimes the hard way, but we are making progress. Things to be optimistic about. Next slide here is kind of showing high frequency economic activity. This data comes in weekly. This one I was able to update through last week, and you can see here towards the end, here towards December, over on the right hand side, you are seeing Omicron show up. It is reducing economic activity. We're still relatively high compared to where we were over the past couple of years, and so again, making progress, but we're at least kind of staying in the range of positive here. Anecdotally, I would say we've seen more absenteeism across the employment picture as people get infected and they have to quarantine at home. Our school system sent out an email last week saying, we've got a lot of teachers that are homesick. At this point, we have administrators covering some of those classrooms because we don't have enough substitute teachers in the system. And just be aware and be flexible, because you may get notified one morning that your school is going remote that day because we don't have enough adults to watch the kids. So, it's a tricky situation here, but again, hopefully towards the later part of this month, we're going to be peaking out in those infection rates, and we'll be onto a sunnier path forward.
Well, I think the thing that's interesting about this high frequency economic data is it begins to really inform why our expectations are for a higher level of volatility as we go into 2022, because you get these swings, and these are some of the more sensitive elements of the economy. There are parts of the U.S. economy that really haven't been as dramatically impacted by the changes in infection rates. But if you look at these kinds of things, whether you're talking about travel, and you can be talking about, the airlines, you talk about hotel occupancy, the cruise lines have been dramatically impacted by this. I think I just saw a notice either late last week or early this week that one of the cruise lines, I'm going to say it was Royal Caribbean, but I may be misspeaking there, but one of the cruise lines suspended all their cruises. It's hard for a business to make money when they don't do business anymore. And so, it's definitely impacting the price of the stocks for those companies who are most dramatically impacted by this. And if you look back at 2020 and 2021, some of the leaders in the U.S. equity markets were those companies that were impacted by COVID, but in a positive way. And so the expectation would be that if COVID becomes less of a factor in the equity markets, that could further accentuate the rotation that Ryan was talking about having started and then kind of maybe stalled a little bit, but it could be refueled if in fact COVID slows down and becomes less of an issue, and you see people being able to get back to the level of eating out that they prefer. They're less concerned about travel, so that picks back up. The cruise lines are able to have cruises again. You'll see some of these businesses that have had their stock prices negatively impacted perhaps come back with some pent-up demand or what have you, and maybe a little bit more of that rotation, which is not just sector-based, but it's actually even in the asset class level, which maybe we'll talk about when we look at some data later in the presentation.
Yep, good point. So we talked, Phil kind of teed it up earlier, the amount of stimulus that we've had in the economy. You can see in 2020 and in 2021, we had record amounts of stimulus from the federal government. A lot of those, paycheck protections and extended unemployment benefits being paid out to workers who lost their jobs during the pandemic. And we would just note that's discontinued at this point. The extended unemployment benefits ended in September of last year. And a lot of that won't be in 22, 23, 24. This is the CBO, Congressional Budget Office forecast going forward. So you can see it's kind of, a fiscal cliff is what they called it, back in the, maybe 10 years or so ago is when the government stimulus payments started falling off. And so you will see that this year, whether or not we get a Build Back Better plan, that is, they're kind of refiguring the numbers to see if they can get something passed. Joe Manchin wasn't going to budge when it was $1.8 trillion. We'll see if they come back to the table. Last time I saw, they said that they still haven't had a discussion, haven't circled back on it. So maybe off the table for a little while. But even if they were to come back with something, I would just note that amount of stimulus is not all in one year. So it wouldn't take us off the charts again here in 2022. That's supposed to be spread out over a number of years. And when it is spread out, it would end up being a pretty small number when you tack it on top of these bars here. So, federal or fiscal stimulus going forward is going to be much less than what it was. So that's going to provide a little bit of a headwind versus where we were the past couple of years. When you look at the gross domestic product, where is the economy right now? This blue line here is the trend growth of 2% since the early 2000s. You can see, when you have a recession, it takes you below trend here in 2008, 2009 timeframe. And then you kind of, you go back on that trajectory, but you have a hard time getting the economy back up to that trend line. Here we see over on the right-hand side of the slide, the COVID pandemic, and we've rebounded very quickly, a lot of it due to the stimulus, both fiscal and monetary stimulus, and the reopening of the economy, people getting back to work, people getting back out there, spending money, and the fourth quarter GDP numbers are not yet in. They come in a little bit later this month, and analysts are expecting around 6.5% growth at an annualized rate in the fourth quarter of 2020, which would bring that gray line back up to the blue line, which essentially would erase the pandemic. It would be as though our economy had gone through this and there was no shutdown or anything like that. So pretty remarkable the bounce back that we've had over the past couple of years. Taking a look at job openings, I would just say no matter what number you look at, the labor market is tight. You can look at unemployment rate is at 3.9%. There are different measures of the unemployment rate. That's the U3 rate. If you looked at U5 or U6, which kind of incorporates those people that are temporarily out of work or who are not working for one reason or another, those are also pretty tight. When you look at the JOLTS report, which is the job openings and labor turnover survey report, you see, kind of record number of job openings out there. I think it's about 11 million jobs are posted. And you see quite a bit of turnover. I think the quit rates are the highest ever at 4.5 million people leaving their jobs, while layoffs from employers are at their lowest level ever. I found this chart pretty interesting. This was from the St. Louis Federal Reserve, and this basically takes the number of unemployed persons and divides it by the job openings that are out there. And, just noting this red line here, going back the past 20 years, that this is at an all-time low number. So there's almost 2 jobs for every person that's unemployed. So, any way you slice it, it's a difficult labor market at this point.
To that point, remember the Federal Reserve has a dual mandate. That dual mandate is, control for inflation and achieve full employment. And so there's a lot of debate about where is full employment. And the numbers that get talked about are generally right around 4%. And so you can make the argument that we are already at full employment and crossing beyond that equilibrium level to a point where there really is a shortage of people in the labor market. One of the things that Ryan and I kind of talked about as we were discussing this webinar today is, well, what would the dynamic look like for more people to be drawn back into the labor market, people who've exited, and certainly as the levels of compensation begin to rise, that's a factor. And it's one of the reasons that I think this is an element to really keep an eye on as it impacts inflation going forward and how it influences Fed policy going forward. There's just a lot to be said about the unemployment rate and the number of people working in our country, because it's going to influence a lot of the decisions that are going to ultimately impact the economy and the markets.
Yep, good point. Switching gears, talking about inflation, because that's the big headline now. And so you look at the overall headline inflation number, and yes, it is high. Some of this, and I just wanted to say, some of this is transitory, some of it is persistent. We've kind of discussed this in the past. Transitory, you look up the definition of transitory, what does that mean? It doesn't actually have a temporal connotation. It doesn't have like a set time, and it doesn't mean short necessarily. It just means kind of temporary, that it will revert back. And so I think, when a lot of economists came out and said, yes, this inflation seems, temporary or short term, it was really meant that, you have some of these kind of base effects, base comparison effects. And so you look at kind of where it was, and I've highlighted them, the bars here in red, where it was right after the virus hit us, and you saw inflation really very low. Some things were negative on a year-over-year basis. And so when you compare those prices going forward, I mean, think about airline prices. Airline prices, as soon as the pandemic hit, nobody wanted to get on an airplane. Nobody wanted to get on a cruise ship. So those prices fell considerably, probably, 30, 40, 50%. And then you fast forward a year later, and those things are back up to where they were before. Well, that's doubling. Those values are doubling. And so some of the prices that go into the inflation number are transitory. They were already transitory. This basically shows in 2020 when the prices fell, that was a transitory fall. When they rise back up 100%, when they've doubled, that's also a transitory rise because they're not going to double again. You think of here is the impact of oil. I've shown here the price of oil per barrel up here, and this is kind of the recession when the pandemic first hit. Price of oil in April actually went negative for the forward month contract because nobody wanted oil at that point. They didn't think that, they thought that we were going into a very steep recession. Nobody was going to be traveling for a long time. And so taking physical delivery of oil was actually costing people money. And so they were willing to pay somebody else to take delivery of the oil. Fast forward a year later, and now the price of oil is, I think right now it's about $80 a barrel. But as we get, to the middle of 2022, we're going to be comparing that price of oil, which, right now, $70, $80 versus a year ago is up about 90%. But as we get into the middle of this year, June, July, when the price of oil, when we're comparing it to $71 or $72 a barrel, that year-over-year comparison is going to be, up about 10%. So it's not going to be doubling or tripling, which is what happened here in the first 9 months of 2021. So some of these comparison effects will prove transitory.
If I could, Ryan, I'm just going to add one thing. I was listening to someone, I wish I could remember who it was so I could give it the correct attribution. I think it was somebody from the St. Louis Federal Reserve who said, you have to understand that transitory does not mean that something that went up is going back down to where it was. That is not transitory. What transitory means is something that went up will not continue going up at the same pace. And so to Ryan's very good point with oil, if oil went from $40 a barrel to $80 a barrel and it stays around 80, that was transitory. It doesn't have to go back to 40 in order to have been transitory. Because again, going forward, you'll have those different year-over-year comparisons, and it ends up being a non-factor, a less significant factor in the overall CPI calculation.
Yeah, great point. A huge impact. I'll back up one slide here. Huge impact to the overall inflation number, especially March through, even kind of through the end of the year was used car prices. I mean, when you look at those, some of those were up 30, 40% on a year-over-year basis. Airline tickets up, had almost doubled. Again, we're still dealing with kind of a semiconductor shortage for automobiles, but those build outs, as I've mentioned before, those semiconductor fabrication facilities they're getting built out. They are, a year or so away from being fully online and in full production. And at that point, and it doesn't mean that the semiconductor shortage is going to continue for the next year, as other fab facilities are producing at higher output rates right now. But it just does mean we're going to have at some point in the next year or 2 years an enormous amount of semiconductors here in the United States, plugging them into cars, and those cars going onto lots. And, you can imagine a state where, you walk onto a used car lot and the dealer's saying, hey, we got a great price for you. We're slashing prices. This car, a few months ago was this much, and we've just cut it, by 30%. For you, we're going to make you a good deal. So just be ready for that. Hold out if you can on changing your car is what I'm saying.
Hey, Brian, what kind of forecasts have you seen for full year inflation for 2022? Is it in that 3 to 4 range?
Most analysts have it coming down towards the end of this year, towards the end of 2022, getting back down to the 3-ish% range, maybe a little bit north of 3. Yeah.
Yeah. So just as you think about the outlook for 2022, inflation should moderate. It'll still be above the stated target that the Fed has set, which informs why the Fed will be acting how it is, which then is a good segue into our next slide, I think.
Yeah. So that's, as of the December meeting, this is kind of where the Fed forecasts where they think interest rates will be, where the Fed funds rate will be. And so you can kind of imply here that Fed funds rate, which is their overnight rate that they lend to banks, was 13 basis points, kind of the middle of their range was 13 basis points. They expect it to get up to 90 basis points by the end of, or by the beginning of 2023, which looks like about 3 interest rate hikes. Now, what started the indigestion in the market beginning kind of last week was I actually went to the St. Louis Federal Reserve, James Bullard's presentation, his outlook on 2022. And he's one of the more hawkish Fed members. And he kind of dropped this idea that, we're wrapping up bond purchases pretty quickly, pretty aggressively, and we could hike interest rates as soon as March this year. And that was kind of the first time that anybody had heard that. And so that's kind of what started this indigestion in the markets right now, is that this idea that, wow, they might hike interest rates a lot faster. They could even do 4 rate hikes this year. Kind of caught some people off guard.
Yeah, I would just have a tip of the cap to Federal Reserve Bank President Bullard. Ryan describes him as one of the more hawkish. He was very dovish a year ago, a little over a year ago. And for him to have evaluated the data and to change his position, I think is something we need a little bit more of. And I just give him a lot of credit for basically saying, hey, look, the data that I was seeing led me to a conclusion, and I think the data has changed enough. I need to take a different stance. And I just give him a lot of credit for basically saying I was kind of wrong and the data's pointing me a different direction now.
Yep. So with interest rates poised to rise, we take a look at the fixed income market, and I think it's important to kind of understand that, the fixed income market is made up of a lot of different types of fixed income, a lot of different types of bonds. Over here on the left-hand side, and this is really, so your vertical axis, as you go up, those are higher yielding bonds, ones that pay a little bit more interest. And then as you go to the right, these are bonds that have a higher correlation to the equity market. As you go to the left, they have a negative correlation to the equity market. And so when you look at these treasury bonds here in blue on the left-hand side of the chart, you notice that they are very negatively correlated to the stock market. However, they don't pay very much. They don't go very high up on this vertical scale. And it's true. The 10-year bond was, at the time of this, December 31st, it was about 1.5%. I think it's now about 1.8%. Jerome Powell may have talked it back down a little bit during his testimony. We'll find out. But suffice it to say, we do get a lot of questions on, bonds are not paying very much. Why, if interest rates are going to go up, isn't that a negative for bonds? And in the traditional sense, yes, it is. As interest rates go up, all else equal, the value of a bond goes down. What you have to understand is that there are really 2 dynamics to bonds. One is interest rate sensitivity, and the other one is credit. And so in the form, for treasury bonds, there is no credit premium to it. They are considered risk-free bonds in the world. Everybody knows the United States as the most responsible debtor out there, one that will always pay back its debts and will never default on its loans. And so there is no risk premium. There's no credit premium in Treasury bonds. So all Treasury bonds have is interest rate sensitivity. When interest rates go up, they do go down. Any of these other fixed income instruments that you see on here, corporate bonds, high yield corporate bonds, emerging market debt, they also have a credit premium to them. And so even if interest rates went up, the demand for something that paid a higher coupon, a higher yield, could be so much that it nullifies any interest rate movement, and the bonds could still not be down for the year, or could even move higher for the year. And I think, here's kind of, it shows what interest rates did last year and into the beginning of this year. You saw the first quarter of last year a huge increase in the 10-year yield, going from about 90 basis points all the way up to about 170 basis points, where we thought, oh man, this is a straight line up here. And then all of a sudden, you got a little bit of relief here. They drifted back down to 1.2, kind of in the middle of the year, and then late in the year and early this year, we've jumped back up. And so, don't read too much into a rise in interest rates. Interest rates are going to move around. Lots of different variables. They're impacted by Federal Reserve hikes. If the Fed pauses and decides, okay, we've made a couple of rate hikes, and now let's step back for a few months and let's see how that works its way into the economy, then you could see rates drift a little bit lower.
Yeah, and I think it's interesting. This just proves how difficult it is to predict what interest rates are going to do, because we were looking at an environment where everybody was getting more concerned about inflation being more persistent instead of transitory. And in the face of that, the 10-year Treasury had, a 4, 5, 6 month period of time where it was generally in decline, which is very counterintuitive. If you're seeing more inflationary pressure and anticipating the Fed acting differently to try to control that, why in the world would the 10-year Treasury drop from 1.8 to 1.3? It doesn't make sense. And so it's very hard to time that. The point I would make is I think Ryan really hit on something that's critical. Bonds have a role in the portfolio, and as these yields increase, it does help us have better protection via the interest that they're paying against further weakness from increasing rates, because you're actually getting some income to offset the price decline. But what we've done is we've really focused on using shorter maturity bonds in our client portfolios so that they're a little bit more insulated from this. We don't have a lot of 10-year bonds in our portfolios. We're going with shorter and even some ultra short maturities. So while the outlook might be a little bit negative, you can protect against some of the risk in the bond market through the types of bonds that you buy. Additionally, I would just encourage all of you, bonds fill a role in the portfolio, and that is to reduce volatility. So even in what was a relatively bad year in 2021, where they lost 1% to 2%, they still gave you that buffer against equity market weakness. We didn't have a correction in 2021. We haven't had a bear market for a while now, this very short one, in response to COVID, of course. And so having the appropriate portion of your portfolio allocated to assets that can mute that volatility is very important. And while bonds have a bit of a headwind that they're going to be facing, to Ryan's point earlier, we've added some other investments that aren't as correlated to the rising interest rates and that are going to give us some protections. But it's not prudent, in our opinion, to abandon bonds. What we need to do is to have the right types of bonds to manage this risk while still providing volatility control.
Yeah, that's a great segue. And I just noticed we got about 9 minutes left. So in the interest of time, we may speed through the last few slides here. But just to kind of put a bow on top of that, this is how different fixed income segments performed in 2021. I would just note these are all Treasury bonds over here. So these are 20-year Treasury bonds. These are 30-year Treasury bonds, which didn't go down as much, and that's because you didn't get a parallel shift in the yield curve. You got interest rates moved up, but kind of flattened out. So at the 30-year bond level, they didn't rise as much, and so it didn't hurt as much. But to Phil's point, the longer the term to maturity for bonds, especially when there's no credit premium to it. You want to kind of stay short if you're expecting a rise in interest rates. In the muni bond market, all muni bonds were up last year, so not all bonds are created equal, as I kind of alluded to earlier. When you look at agency bonds, they were down, less than what the kind of 10-year Treasury was down. Treasury was down 4%. Agency bonds only down 1.3%. Mortgage-backed securities down 1%. Corporate bonds only down 1%. So in the grand scheme of things, bad year for the bond market is not down 30%. When you're looking at something like a diversified portfolio like the Barclays Ag or something like that, it's down 1.5. And then if you shorten duration, which is kind of what we do, we want the stuff that's a little bit shorter. It's much less much more muted. These are kind of the alternatives that we use for helping portfolios. Again, we kind of use these so that we don't have interest rate sensitivity. So, you've got merger arbitrage, which was flat, multi-strategy funds, which were up about 5%, non-traditional bonds, managers that are managing for higher interest rates. And so they were up. And then alternative lending is a good category. Transitioning over to kind of corporate EPS earnings growth, I would just say it was a huge year for corporate earnings. A lot of that was this rubber band effect of what happened in 2020, a lot of losses in 2020. We also had a lot of gains and a lot of margin expansion, really driving the picture for corporate profit growth. Going forward, I think I saw JP Morgan expects another 10 to 14% earnings growth in 2022, even as the Fed begins to raise rates. So still good outlook for earnings growth.
And to that point, if you can go back to that slide for just a minute, Brian, I'm going to use this as an opportunity to answer a question that's come in from one of our participants. And you just said something that I thought was really interesting, that there was significant margin expansion in 2021 as these labor costs were escalating. And the question we got was, do you anticipate any significant effect of increased organized labor activity on corporate profits? And I would say I definitely have an expectation that increased organized labor, along with some other factors, could contribute to higher labor costs. But does that necessarily mean that it reduces corporate profitability? Not necessarily. And so what we've seen is a tremendous amount of pricing power on the part of corporations and able to pass through higher costs to their customers that's allowed them to maintain their margins, or, as this chart illustrates, even expand on those margins. There's probably a limit to that, but I wanted to expand the answer to the question because increasing organized labor won't be the only thing that drives labor costs. I just saw an article that as of January 1st, there were 20 something states that increased their minimum wage. And the impact of increasing minimum wage is not exclusively felt by companies that hire minimum wage employees. It has a tendency of pushing labor costs higher across all of the lower end wage segment. And so there are other things that are going to be driving some higher labor costs, which could impact corporations, but generally they do go ahead and find the ability to try to pass that along. It may not be immediate, but so far, corporations have done a pretty good job of managing that. Organized labor is a much smaller impact on corporations today than what it was, and we've seen a couple of instances where that's coming back the other way. And I think that's a reflection of the labor shortage that we have and a transition of some of the power back to the employee from the employer compared to what we've seen over the recent past.
Yeah, and I would note I also read an article about productivity growth and how that's driving corporate profitability. So you look at a lot of retailers. Go into a retail store, Target, any of them, and you can see more self-checkout kiosks and less people checking people out. You've got more people stocking shelves, and so they've kind of recalibrated their labor, and so they're pushing more people to, get the boxes on the shelves and less people on the checkout lines. And so for the past 15 years, we've had productivity in America has been about 1%. It's been very, very low. And there was this productivity conundrum. Why is productivity so low? In the past 2 years, that has jumped to 4%. It's huge, and a lot of it is due to retailers and everybody kind of reorganizing and recalibrating their labor. So, yeah, great question, great point. Last couple of things here. Still expecting good growth. Are the U.S. stock markets overvalued? Here's where we kind of sit as of last Friday, about 20 times forward earnings. I would just note, these jagged lines here, dotted lines here represent one plus and minus one standard deviation, which basically means 2/3 of the time this number, this valuation will be in between these two lines here, 2/3 of the time. So we are just barely on the 2/3 of the time. So, we're not wildly overvalued, moderately, sure. But if we continue growing earnings, and that's the bottom line of the forward PE ratio, then this valuation number will dip back down into that range of between these two lines. So
I think that's a really critical point. As much as the market was up in 2021, the U.S. market is less expensive now than it was at the beginning of the year. And that is because the earnings grew even more quickly or more dramatically than did the price. And that could happen again this year. Ryan, you shared the earnings expectation for the S&P 500 from, I think it was JP Morgan, at 10 to 14%. And so if prices went up 6, 7, 8, 9%, but earnings increased 10, 11, 12, 13%, stocks become less expensive even though their prices go up. It's an important thing for us to remember as investors.
Yeah. And again, we're looking at, this is the overall S&P 500. There's a difference between growth stocks and value stocks. And so one of the questions that we had before the presentation was, what do you do with an outlook of, rising interest rates, stock market may get more volatile, rising inflation, build back better, more fiscal stimulus. Those things, they all kind of look like value stock beneficiaries. So, we're looking at an overall valuation number of 20.47 times. That's the overall market number. That includes growth stocks. If you look at value stocks, that multiple is much lower. And the next slide here kind of shows you the dispersion between the most expensive quintile of stocks in the S&P 500 versus the cheapest ones. And I would say that spread in valuation is at the highest level it's been at since they've kind of been keeping track of it here, going back to 97. So for us, we would direct you more towards value stocks. These things are going to be beneficiaries of infrastructure projects, because these are like engineering companies, they're basic materials companies, they're transportation companies. They're not growth stocks like software companies. And then lastly, I would say, as we kind of alluded to earlier, international stocks are pretty cheap. You see this, U.S. stocks are at 20-ish, little 21% or 21 times earnings, which is much higher than their 25-year average. They're kind of near the top of that range. Look at, Europe, Japanese stocks, emerging markets, China, they're all, right around their long-term average. So, we say stay diversified, kind of tilt towards value, don't abandon international stocks, and with your fixed income, not everything is created equal. We don't invest in long duration, treasury bonds. We're selectively diversified.
And so if you entered into this webinar doubting that Ryan and I get excited about this kind of stuff, we've changed your opinion a bit. Forgive us. We recognize that it is now right at 11 o'clock and we've used our hour. I do want to leave you with just a couple of kind of concluding thoughts, kind of what have we done or what are we doing as a byproduct of this outlook. And again, we don't believe in trying to time the market. We don't believe in a lot of tactical moves, but we are aware of the environment in which we're investing, and we make decisions predicated on that. And so one of the things we've done is we've looked at your portfolios either through the meeting process or when there's a cash flow from the portfolio, we as an advisor team have been very focused on rebalancing clients so that they have the full complement of the volatility control building blocks in their portfolio, recognizing that we've had 2 very good years, that markets are at or near all-time highs. And so we're trying to make sure that the capital preservation assets in your portfolio, the bonds and the other alternatives, are at their target weights, even where there were some capital gains that might have needed to be realized in order to do that. We definitely think that now is a good time to make sure that we have that full complement of volatility control assets. Additionally, we think this is a good time to be verifying that the asset allocation, the structure for the portfolio, remains appropriate. In fact, we just distributed an article yesterday. If you haven't seen it yet, you might enjoy reading it. It's called, "Are You Prepared for the Next Bear Market?" And one of the things that we went out of our way to try to emphasize is it's not a prediction that a bear market is imminent by any stretch of the imagination. But one of the things that we think is a key component to being appropriately positioned when a bear market occurs is, before it happens, make sure the structure is still appropriate. And as you go through life, as your goals are achieved or as your level of assets builds, it's appropriate to revisit that. And as your advisors, we would welcome the opportunity to sit down and have that conversation. We bring that up in meetings very intentionally, particularly in seasons like this, to make sure that the equity exposure is appropriate for your risk tolerance and your goals. The third thing that we are doing or have done, we've already shifted bonds, like Ryan was talking about. We've already shifted to those shorter maturities. Interest rates have been at or near zero for a while. The yield curve's been very flat. There hasn't been a lot of difference in the interest rate you get paid for a very short-term bond versus a little bit longer-term or an intermediate-term bond. And so we've already positioned to help preserve that part of a client portfolio when rates move up. And I think we are well positioned for that. The non-traditional bond fund managers that we're utilizing in portfolios are positioning themselves for that. And we've introduced some new assets that also are further complementing that. And we actually had a shift over the last, forgive me, the older I get, the more nebulous time is. I think it's over the last 12 to 18 months, we as a firm have been increasing the allocation to things that reduce volatility that aren't bonds for exactly the season that we think we're entering into here as we move into 2022, where the Fed's going to be raising rates and the rest of the yield curve will react. The other thing that we've done is we've tried to add some new investments, and that's something that is an ongoing exercise for us. So if we haven't had the opportunity to have a conversation with you, it's not something that has to happen right now today, because next week it'll be too late. But if we think about the next 1, 3, 5 years, there are some new assets that we think make a good addition to a client portfolio, and we continue to do research into that. And I would fully expect that over the next year or two, there will be more investments that we bring to clients and lay out the argument for why that could be a good addition to the portfolio, to do one of two things: either reduce the risk of the portfolio or improve the return, or when we're really blessed, something that does both. And then the other thing that I'll share with you, volatility doesn't have to be bad. It can be a little bit nerve-wracking. It can make us nervous, but data would suggest that if you have a plan and you apply that plan during periods of volatility, you can actually enhance your investing results. What do I mean by that? If you own stocks and bonds, and stocks have a period of strength as they have had, and you sell and take profit out of those stocks to buy those bonds to get your volatility control assets back to their intended target, that discipline puts you in a position of you're taking profit. It's not a real complicated concept to buy low and sell high. It's just difficult to implement. And as your advisors, and the discipline we bring to the application of your asset allocations, that's where we really get that selling low, buying high performance. And if, in fact, the equity markets do have a correction of 10 to 20%, and we take advantage of that opportunity to sell some of those volatility control assets to buy stocks when they're under pressure, that's going to help you recover more quickly and augment your return versus bury your head in the sand and don't do anything kind of performance. So those are some of the key things that we're doing. I'm looking, I don't see any other questions. And again, forgive us for going long. We're willing to stick around for a few minutes. If any of you need to sign off, we respect that and understand that. But if you have questions that you'd like us to answer that haven't already been addressed, please enter them into the Q&A and we'll do that. Ryan, anything else that you would add by way of kind of a closing comment while we wait to see if there are any final questions?
I don't think so. I think we covered just about everything. There's more detail, but I don't think anybody wants to know the detail. Just me and you.
That's right. So certainly as you have opportunities to meet with our team, certainly don't hesitate to bring any questions you have. But hopefully you found this helpful, and we hope that all of you have a very healthy and happy new year, and look forward to seeing you soon.
Thank you, everybody.